Gold has stayed exactly the same. What's changed is the value of the dollar. You used to be able to buy an ounce of gold for $20. Now you need $2,600 to buy the same ounce. So if gold can go from $20 to $2,600, it can go from $2,600 to $26,000. The only question is, how much longer is it going to take to get to those prices? But I think the rate at which the dollar is going to depreciate is going to accelerate. So I think the dollar is going to start losing value faster than it has over the prior 10 or 20 years in an even higher gold price. But again, it's not gold going up. It's the dollar going down and the euro going down and the pound going down and the yen going down. All these currencies are being debased. It's not just the dollar.
Gold prices have remained resilient amid growing expectations of a 25 basis points interest rate cut by the U.S. Federal Reserve in November. According to the CME Group's FedWatch, tool markets currently price in an 86% chance of such a move, supporting the precious metals performance. PeterSchiff, CEO and chief global strategist of Euro-Pacific Capital, has long advocated for free market economics. He predicts that gold's price will rise sharply, not because of an inherent increase in value, but due to the weakening of global currencies like the US dollar, euro, and yen. This devaluation, driven by inflation and other economic factors, is likely to push gold prices higher in the coming years. The US dollar's recent failure to maintain its recovery from two-month highs against major rivals further fueled the rise in gold prices. A sharp decline in two-year US Treasury bond yields also contributed to gold's rebound from multi-week lows. The drop in the dollar-yen partly influenced the USD's retreat following hawkish remarks by Bank of Japan Deputy Governor Ryozo Himino. He stated that if the economic and inflation outlook presented in the BOJ's July report is met, the central bank will raise interest rates accordingly. Schiff has frequently pointed out that gold's value has historically remained constant. For example, an ounce of gold cost $20 up until 1933. However, after President Nixon removed the U.S. from the gold standard in 1971, the dollar's value plummeted, and today it takes about $2,600 to purchase the same ounce of gold. This highlights the dollar's significant depreciation while gold's intrinsic value remains unchanged. Currency fluctuations can periodically impact capital markets. For much of 2024, currency markets were relatively stable, with the dollar and euro trading within a narrow range. By mid-September, their relative value was close to where it started at the beginning of the year. However, shifts in monetary policy and global inflation trends have created new uncertainties. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
But I still think gold is cheap historically. I think the level now is about 16 to 1 or so, 16 ounces of gold to buy the Dow. I think, it's going much lower. I mean, certainly below 10, probably below 5. Whether it gets to 1 to 1, it's a tough call. Maybe 2 to 1. But even 2 to 1, where would that be? Well, gold would have to be 20,000 if the Dow is 40,000. But, we've been there. We've been at 1 to 1 almost twice in 1932 and even 1980. 1980, it was $800 for an ounce of gold and $800 for the Dow. So they were about 1 to 1, or they're approximately. Now, that represented a very cheap Dow and very expensive gold at that point in time, but it happened, right? So if it happens again, right, it doesn't mean that, gold should be that expensive or that the Dow should be that cheap, but it can happen. But right now, the price is still too high for the Dow relative to gold. So I forget what the long-term average is, but it's lower than it is right now. So gold is cheap, relative to the stock market. And so that's going to change because the stock market should not be as richly valued as it is, given the enormity of the problems that are not being priced in. But that said, right, if we have hyperinflation or even extremely high double-digit inflation, then you would expect the Dow to price that in, but not in terms of gold. So I can be very bearish on the Dow and think that it's overpriced or overvalued, but that doesn't mean I don't think the price can go up in terms of dollars. It absolutely could go up. I mean, the Dow can go to 100,000, but if gold goes to 50,000 at the same time, the Dow has crashed because now we're down to 2 to 1 from 16 to 1. So you have to look at both prices to know what the Dow is really doing, because you got to separate out the dollar, because the dollar has lost a lot of value. When the country started in 1789, you needed $20 to buy an ounce of gold. And even as late as 1933, before Roosevelt devalued, you could still get an ounce of gold for $20. That's like 150 years, and the dollar didn't lose any value. But starting in 1971, because gold was still $35 an ounce until 1970. But once Nixon took us off the gold standard, now you don't need 30. You can't buy an ounce of gold with $35. You need $2,600 to buy that ounce of gold. Now, what has changed since 1970? The gold hasn't changed. Gold is exactly the same, right? They haven't improved gold. Right? Gold is not like a car or a telephone, something that's gotten better, right, over time, because we have better ways of making it. Gold has not changed. It's exactly the way it was 5,000 years ago. What's changed is the value of the dollar. You used to be able to buy an ounce of gold for $20. Now you need $2,600 to buy the same ounce. So if gold can go from $20 to $2,600, it can go from $2,600 to $26,000 or $260,000. The only question is, how much longer is it going to take to get to those prices? But I think the rate at which the dollar is going to depreciate is going to accelerate in the years ahead. So I think the dollar is going to start losing value faster, let's say over the next 10 years, than it has over the prior 10 or 20 years. So I think you're going to see that reflected in an even higher gold price. But again, it's not gold going up, it's the dollar going down, and the euro going down, and the pound going down, and the yen going down. All these currencies are being debased. It's not just the dollar.
PeterSchiff argues that the rise in part-time hospitality jobs does not reflect economic strength. Many workers are taking on second or third jobs to offset inflation and a weakening economy. Moonlighting is at a record high, with Americans working longer hours for less. However, recent labor data complicates this narrative. The U.S. added 254,000 jobs in September, far exceeding expectations of 150,000, while the unemployment rate fell slightly from 4.2% in August to 4.1%. Data from previous months were also revised upward, with August gaining 17,000 additional jobs, now totaling 159,000, and July revised up by 55,000 to 144,000. Economists had anticipated the unemployment rate to remain unchanged at 4.2%. This unexpectedly strong job growth comes at a critical time, just a month before Election Day, with the economy under close scrutiny as Vice President Kamala Harris and former President Donald Trump campaign for the presidency. The labor market's resilience may be seen as a positive sign, but Schiff's concerns about the quality and sustainability of these jobs remain relevant amidst the broader economic uncertainties.
I think it was the latter part of the 1980s that we stopped running surpluses and started running deficits. And that's why now, instead of being the world's biggest creditor nation, which was true in the 1980s, we're now the world's biggest debtor, because those persistent trade deficits have eroded away our wealth. And so we've gone from the world's biggest creditor to the world's biggest debtor. And in fact, we have so much debt that if you add up all the other debtor nations together and combine their debts, you still don't get the U.S. Yeah, we've been trending down. I mean, we almost got through 100. I think we got down to about 100.2, and then we got a big pop the other week, and we're back at 102.5-ish. That was because we got some economic numbers like that jobs number we talked about, a few others that were not as weak as expected, or what some consider to be strong. And so that pushed back some of the rate cut bets, and so that got the dollar to balance. But the trend is down. The Fed is cutting rates. The economy is weakening. That narrative will be back on the front burner once we get some more negative surprises on the economic front. Meanwhile, manufacturing numbers have been dismal the entire time. We continue to lose manufacturing jobs. All the manufacturing ISM PMI numbers are solidly in contraction mode, and they've been there for a couple of years. So nothing has improved on the manufacturing front. Yeah, we have more people tending bar and waiting tables. I mean, that was the biggest category of private sector jobs in the last jobs report. Waiters and bartenders. Now, I mean, you can't build an economy on waiters and bartenders. I mean, the problem is some of these waiters and bartenders used to work in manufacturing, and now they're waiting tables. That's the only thing they can do. And a lot of these jobs, the reason we create so many jobs in restaurants and bars is because they're part-time jobs. And that's just how they fit them into people's schedules. They work 10 hours, 5 hours. They work some shifts. Some people work at night. A lot of these waiter and bartender jobs are people who are taking second and third jobs because that's the only way they can pay the rent, or, keep the lights going or, put food on the table. Moonlighting is at an all-time record high. That's another statistic in the jobs report last week. The number of people working multiple jobs hit another record high. And, that's not a sign of a strong economy. When people are forced to take multiple jobs to make ends meet, that's not what people want. People want leisure. They want to work less, not more. But they have no choice because the economy is so weak and inflation is so strong that they have to work longer and longer hours just to eke out the same or even a diminished standard of living.
While recent labor statistics may suggest a resilient job market, the underlying issues of inflation and the rise in part-time work indicate deeper economic challenges. As Schiff emphasizes, the perceived strength in employment may mask the reality of a struggling economy, where many are forced to juggle multiple jobs to make ends meet. This raises critical questions about the sustainability of such growth and the broader implications for the economy moving forward. What do you think will be the long-term impact of these trends on the American workforce and the economy? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.